Hello everyone, this is Sia Jane and welcome back to my channel. So, I'm going to be creating a series or playlist of videos where I'm going to be revising every single AA topic in your syllabus to help you better understand the topics for your exam. Just an note: these videos should only be used for revision purposes and not for studying. Sorry, my handwriting is a little bad. Yeah, so these videos should only be used for revising and not for actual studying. And yeah, so let's get started. So our first chapter is going to be introduction to assurance. So let's start with the basic question: what exactly is assurance? In simple words, assurance means giving confidence and information. When a professional like an auditor examines certain information and they gives an opinion about whether that information is reliable, that process is called assurance. Okay, so why is this important? Because the people using the information, like investors or lenders or shareholders, need to make decisions. If the information might be wrong, their decision could also go wrong. um yeah, so when assurance is provided, the risk that the information is incorrect is reduced, so and users can make more confident decision. Now let's take a look at the formal definition given in the international framework for assurance engagement. An assurance engagement is an engagement where a practitioner obtains sufficient appropriate audit evidence um in order to express a conclusion, and that conclusion is meant to increase the confidence of the intended user other than the responsible party about the outcome of the evaluation or measurement of a subject matter against criteria. And I know that the definition sounds a bit heavy, so let's break it down. Basically, what happens is a professional examines some information, collects evidence, and then gives an opinion so that the people using that information can trust it more. Now, to understand assurance properly, you must remember the five elements of an assurance engagement. These five elements are extremely important and are often tested in exams. So, let's go through them one by one. The first element is a three party involvement. Every assurance engagement involves three different parties. The first one is the practitioner. Uh, this is the profession who performs the assurance work, usually an auditor, you can say. Sorry. The second is the intended users. These are the people who rely on the information to make decisions. For example, investors or shareholders. If you could just note it down somewhere, it will be easy for your revision. And the third is the responsible party. This is the person or organization responsible for preparing the information that is being examined. So remember, practitioner, intended user, and responsible parties. These three parties must always exist in an assurance engagement. Now, the second element is appropriate subject matter. This simply means that the information that the practitioner is examining, uh, for example, it could be financial statements, sustainability reports, internal controls, or compliance reports. Basically, it is the information on which assurance is being provided. Info on which assurance is being provided. The third element is suitable criteria. Now, when we examine information, we need something to compare it with. That comparison standard is called criteria. These criteria could be accounting standards, laws, regulation, or other guidelines. So, the subject matter is always evaluated against certain criteria. The fourth element is sufficient appropriate evidence. Before giving an opinion, the practitioner must collect enough evidence, and the evidence must also be reliable and relevant. Only after collecting sufficient and appropriate evidence can the practitioner form a conclusion. And finally, is the written assurance report. At the end of the engagement, the practitioner prepares a formal written report. In this report, the practitioner expresses their conclusion or opinion about the subject matter. This report is what users actually read and rely on. So let's quickly revise the five elements of the assurance engagement. the three-party involvement, the appropriate subject matter, the suitable criteria, the sufficient appropriate evidence, and the written assurance report. If you remember these five elements, you have already covered a very important foundation of assurance. Now that we understand that the five elements of assurance engagement, let's look at how these elements apply in two different situations. On one side, we have financial statement audit, and on the other side, we have an assurance engagement on a forecast. This comparison helps us understand how the five elements appear in different types of assurance engagement. Let's go through them one by one. First, we have the three-party involvement. In the case of a financial statement, the practitioner is the auditor. In a forecast assurance engagement, the practitioner is also an assurance provider, but not necessarily performing a traditional audit. The intended users are also slightly different. For a financial statement audit, the intended users are usually the shareholders because they rely on the financial statement to assess the company performance. However, for a forecast, the intended users are usually the directors or potential providers of finance, um, such as bankers or investors who want to know whether the forecast is reasonable. The responsible party in both cases is the directors. This is because the directors are responsible for preparing the financial statement as well as preparing the forecast. Next, the second element is the appropriate subject matter. For an audit, the subject matter being examined is the financial statements. But for a forecast engagement, the subject matter is the forecast itself, which is basically the company's estimate of future financial performance. The third element is suitable criteria. For for financial statement audits, the criteria used are the financial reporting framework, such as accounting standards. In the case of a forecast, the criteria include appropriate assumptions as well as a financial reporting framework. This is because forecasts are based on assumptions about the future, so those assumptions must be reasonable. The fourth element is the sufficient appropriate evidence. In an audit, auditors obtain evidence by performing audit procedures such as test of control, test of detail, or analytical procedures. These procedures help the auditor verify whether the financial statements are reliable. However, when examining a forecast, the practitioner performs examination procedures instead. These might include inspecting documents, making inquiries, or performing again analytical procedures. These are common. The goal here is to not prove the future will happen, but to check whether the assumptions made used in the forecast are reasonable. Finally, the fifth element is the written assurance report. In the financial statement audit, the output is the independent auditor's report. This report contains the auditor's opinion on whether the financial statement give a true and fair view. This report contains the auditor's opinion on whether the I read it again. But in the case of a forecast engagement, the practitioner provides an independent assurance report. The report usually states whether anything has come to the practitioner's attention, suggesting that the assumptions are unreasonable, and whether the forecast has been prepared based on those assumptions. Now, let's understand assurance with a very simple real life example. Imagine someone is buying a house. When you buy a house, you usually have to pay a very large amount of money, but there's always a risk. What if the house has serious structural problems? What if the building is unsafe or needs expensive repairs to make it livable? If the buyer doesn't check properly, they might end up spending a lot more money later. So, how do buyers reduce this risk? Usually, they hire a property surveyor. Now, let's connect this example to the elements of an assurance engagement. The buyer of the house is the intended user. Okay. Because they are the person making the decision, the property surveyor acts as the practitioner, meaning the professional who performs the assessment. The subject matter being examined is the structural condition of the house. The surveyor inspects the house and compares its condition with building regulations, best practices, and other technical criteria. After completing the inspection, the surveyor prepares a written report explaining whether there are any structural or problems or deficiencies. This report gives the buyer confidence about the condition of the house and helps them decide whether they should buy the property or not. In this situation, the responsible party is actually the current house owner, because they are responsible for the property, and the evidence is gathered through visual inspection of the property. So, even though this example is not related to accounting, it clearly shows how assurance works in real life. A profession examines something, collects evidence, and then provides a report so that someone else can make a better decision with more confidence. Now, let's look at some common examples of assurance engagement. The most well known example is the audit of financial statement, where auditors check whether financial statement present a true and fair view. Another example is review of financial statement, which provides a lower level of assurance compared to full audit. We can also have systems reliability reports, where professionals assess whether a company's system are reliable and functioning properly. Uh, Another important area is the verification of social and environmental information, especially today when companies report on sustainability and environmental impact. There can also be reviews of internal controls, where professionals examine whether a company's internal system are effective. And finally, in the public sector, we often see value for money audits, which evaluate whether government organizations are using resources efficiently and effectively. Now, when assurance providers perform these engagements, they must follow certain important principles. First, they must comply with ethical requirements. This means acting with integrity, objectivity, and independence. Second, they must apply professional skepticism and professional judgment. Uh, in simple words, they should not just accept information blindly, they must question and critically evaluate evidence. Before accepting an engagement, they must also confirm acceptance and continuance procedures. This ensures they only take work where the risk is acceptable. Next, the practitioner must agree the terms of the engagement with the client so that both parties clearly understand the scope of the work. They must also comply with quality management standards to ensure the work meets professional standards. Another important step is planning the engagement properly, so the work is performed effectively and efficiently. During the engagement, the practitioner must obtain sufficient and appropriate evidence to support their conclusion. They must also consider a subsequent event, which are events occurring after the subject matter period that might affect the conclusion. Finally, the practitioner forms a conclusion which may provide either reasonable assurance or limited assurance depending on the type of the engagement. And of course, all the evidence and work performed must be clearly documented so there is a clear record of how the conclusion was reached. Alright, so let's move to something very important for exams, the types of assurance engagement. There are only two types, so if you remember these clearly, you'll score easy marks. The two types are reasonable assurance engagement and limited assurance engagements. Now let's understand in a very simple way. One gives high confidence and the other gives moderate confidence. Let's start with reasonable assurance engagement. In this type of engagement, the practitioner gathers sufficient and appropriate evidence um, so that they can draw reasonable conclusions. Now, you might be wondering, what does reasonable mean here? It basically means a high level of assurance, but not absolute certainty, because in real life it is impossible to check every single transaction. To achieve this high level of assurance, the practitioner performs very thorough procedures. These procedures usually include test of controls, whether the auditor checks the company internal system are working properly, substantive procedures, whether the auditor directly checks financial importance. Because these procedures are detailed and extensive, the practitioner can conform in all material respects with the suitable criteria. And because the practitioner is highly confident, the report uses positive wording. This is the wording which is used in reasonable assurance. Now let's move to limited assurance engagement. As the name suggests, this provides a lower level of assurance compared to reasonable assurance. The practitioner still gathers sufficient and appropriate evidence, but the procedures performed are very much fewer. Instead of very high detail testing, the practitioner mainly performs inquiry, meaning asking questions to management, maybe analytical procedures, or since the procedures are less extensive, the practitioner cannot give a strong opinion or a strong or positive opinion. And these are the wordings which are used in a limited assurance engagement. Notice the difference. The practitioner is not saying everything is definitely correct. They're simply saying that they did not find anything suggesting that it is incorrect. That is why a limited assurance provides moderate or lower confidence compared to an audit. Now, here's a quick exam trick to remember all of this. Think of this like a reasonable assurance means a deep investigation, and limited assurance means a quick check. Because of this difference, reasonable assurance engagement have more regulations and standards, and the procedures. Sorry, I cannot just write and speak at the same time. I'm just going to note it down over here so you can copy down in your own notes. Reasonable assurance means a deep check, and limited assurance means a quick check. Okay, so the reasonable assurance engagement have more regulations and standards. The procedures performed are more detailed and extensive, and the evidence must be of higher quality. Yes, so let's move on. This is the second most important topic: our external audit engagements. You might remember from the previous section that there are two types of assurance engagement: reasonable assurance and limited assurance. An external audit is actually the most common type of reasonable assurance. That means auditors perform extensive procedures and collect strong evidence so that they can provide a high level of assurance to users of financial statements. Now, the question is, why do we need an external audit? According to ISA 200, which is overall objectives of the independent auditor and the conduct of an audit, the purpose of an external audit is to enhance the degree of confidence of intended users in the financial statements. In simple words, the audit helps most people trust the financial statements more. Because remember, many different types of people rely on the financial statement, such as investors, shareholders, bank lenders, and analysts. These users need to know whether the financial statement they are relying on is reliable and accurate, and that confidence is created when the auditors express an opinion on the financial statements. So, what does the auditor opinion say? The auditor's opinion basically answers two key questions. First, do the financial statement give a true and fair view? And second, are the financial statement prepared in accordance with the applicable financial reporting framework? Usually, this framework refers to the accounting standards. In the context of your audit and assurance exam, we assume that companies prepare financial statement according to the IFRS standards. Um, the this phrase. So, what does true and fair actually mean? This phrase appears all the time in audit, so it's very important to understand it. Let's break it down. True means the information is factually correct. This means it follows accounting standards, complies with relevant laws, matches the underlying accounting records. In other words, the numbers are accurate and properly recorded. Now, let's look at fair. Fair means the information is clear, impartial, and unbiased, and it reflects on the commercial substance of transactions, not just their legal form. So when auditors say financial statement give a true and fair view, they mean that the information is both accurate and presented honestly. Now let's look at the now let's look at the three objectives of an auditor. Objective number 1: the auditor must obtain reasonable assurance that the financial statements are free from material misstatements. Now, these misstatements could happen because of fraud, which is intentional, and error, which is unintentional. But the key word here is material. That means the misstatements must be significant enough to affect users' decision. Second, the auditor must express an opinion on whether the financial statements are prepared in accordance with the applicable financial reporting framework such as IFRS. Third, the auditor must report their findings. This means preparing the auditor's report and communicating the results according to the International Standards on Auditing, also known as ISAs. Alright, now let's talk about something very logical. Why do we even need an external audit in the first place? Think about how most companies are structured. The shareholders are the people who provide the money to the company. They invest their funds expecting the company to grow and generate returns. But here's the interesting part: most shareholders are not involved in the day to day running of the company. Instead, they appoint directors to manage the company on their behalf. So basically, shareholders equals to the owners of the company, and the directors are just the managers. अरे, हाँ. The directors run the company and try to achieve the company's objectives, which is usually maximizing shareholder wealth. Now, because the shareholders are not running the company themselves, they rely on the financial statements to understand how the company is performing. These financial statements tell them things like how profitable the company is, which assets the company owns, how much debt it has, and who prepares these financial statements. The directors. Now, here comes a potential problem. The directors might have incentives to material the extra financial statements. Okay. Uh, for example, maybe they want to show higher profits to impress investors, maybe they want to hide poor performance, or maybe they want to secure bonuses tied to profit targets. So, if the people running the company are also the ones reporting the results, there's a risk that the information may not be completely reliable. And this is exactly where the external auditor comes in. An independent auditor reviews the financial statement, checks whether they give us true and fair view, and this independent review increases trust and confidence in the financial statements. So, in many developed countries, large companies and publicly listed companies are actually required by law to prepare annual financial statements and have these financial statements audited by an external auditor. This is called a statutory audit. However, some smaller companies might not legally require an audit, but even then, the companies still choose to have one. Why? Because sometimes shareholders, banks, or investors demand it before providing funding. And honestly, audits provide several important benefits. So, let's look at some of the major benefits. Yes. First, an audit improves the quality and reliability of financial information. When users know that the financial statements have been independently checked, they trust the information more. This also improves the reputation and credibility of the company in the market. Second, audits provide independent scrutiny. This means an external professional carefully examines the company's records, which can be actually very valuable for management as well. Sometimes auditors even identify weakness or mistakes that management don't notice. Third, audits help reduce the risk of fraud and error. Just the presence of an auditor can act as a deterrent. People are less likely to manipulate numbers if they know someone independent will check them. And of course, audits can sometimes detect fraud, bias, or errors during the review process. Another benefit is that audit enhances the credibility of financial statements. For examples, banks rely on audited financial statement before giving loans. Tax authorities may trust audited reports more. Investors feel more confident investing in audited companies. Finally, auditors can also identify deficiencies in internal control. This means weaknesses in the company's system and process. Where these weaknesses are reported, the company can improve its internal system and reduce future risk. Alright, now let's talk about another type of assurance engagement called a review engagement. Oh, sorry, I am on the wrong page. Alright, everyone, let me ask you a question. Imagine a company hires an auditor. After the audit, the auditor signs the audit report. Now, what do most people think? They think, oh great, the auditor has checked everything. Every transaction, every rupee, every invoice, the financial statement must be 100% correct. But is that actually true? Not really. And this understanding between what people expect auditors to do and what actually auditors do is called the expectation gap. So, what is the expectation gap? The expectation gap is the difference between what users of financial statement or think auditors do and what auditors are actually responsible for doing. Uh, in simple words, people just expect too much from auditors. So, what are the limitations of an audit? Audit Audits have certain inherent limitations, which means it is impossible to provide absolute assurance. Auditors can only provide reasonable assurance. Let's understand why. The nature of the financial reporting. Financial statements include estimates and judgments. For example, estimating bad debts, estimating depreciation, estimating provisions. These numbers are not exact calculation. They involve management judgment. And where the judgment exists, bias can exist too. Uh, Auditors rely on information provided by the client. But what if the documents are incomplete or the documents are falsified? If management intentionally hides something, detecting it becomes much harder. Auditors can rely on a company's internal control system, but internal controls also have limitations. For example, human error, management override, or collusion between employees. So, even good controls are not perfect. Most audit evidence is persuasive. Most That means it suggests something is true, but it may not be absolute proof. Auditing is a bit like solving a puzzle. You gather different pieces of evidence, and together they form a reasonable conclusion. Um, as we discussed earlier, auditors do not test all transactions. Testing everything would take years and cost a fortune. So auditors usually use sampling techniques to make the audit practical and efficient. And financial information needs to be reported quickly. If auditors spend months or years investigating every detail, the information would become irrelevant. So audit must be performed within a reasonable time frame. So let's move on to review engagements. Just give me a second to drink water. Yes. So now let's talk about review engagement. Imagine you own a small or medium-sized company. Um, Now legally your company does not require a full audit, but you still want some level of credibility for your financial statement, maybe for bank investors and partners. So what you can do, instead of a full audit, the company may choose to have a review of its financial statements. A review engagement provides some assurance to users, but it is less expensive and less time consuming than an audit. So the assurance is lower than an audit, but it still gives users some confidence on the financial statements. So what are the audit procedures performed in a review? This is the big difference. In an audit, auditors perform many detailed procedures like test of control, substantive testing, verification of transactions. But in a review engagement, the procedures are much lighter. The practitioner mainly performs two things: analytical procedures and inquiries of management. Uh, yeah, so that's it. Let's move on to the next page. Uh, that's about incorporation and the separation of ownership and control. So let me ask you something. When someone starts a business, what forms can it take? Usually business operates as sole traders, partnerships, limited companies. And the most important interesting thing for one of us is in auditing the limited company. Why? Because limited companies provide protection to investors. This means shareholders cannot be held personally responsible for the company's debts. So, if the company fails, the shareholders only lose the amount they invested, not their personal wealth. And the process is creating a limited company called incorporation. So, what happens when a company is incorporated? When incorporation happens, a few very important things change. First, there is now a legal distinction between the business and its owners. In simple words, the company becomes a separate legal entity. This means the company can own assets, enter contracts, take loans, even be sued, sorry. Yes, yeah, and all its in own name, separate from its owners. Second, incorporation allows the owners to detach themselves from daily operations. In other words, shareholders do not have to run the company themselves. Instead, they appoint professional managers or directors to manage the business. Since shareholders are not managing the company, directors handle the day-to-day operations or transactions. Now we have two different groups: the shareholders, the owners of the company, and the directors who are the managers of this company. And this creates a very interesting situation. Even though incorporation protects shareholders financially, it can also create conflicts of interest. Let's understand this. Shareholders want one thing: to maximize their wealth. They want the company to generate high profits so the value of their share increases. But directors may have different motivations. Directors may want to maximize their own wealth through higher salaries, bonus, or perks and benefits. And sometimes these benefits reduce the company's profitability. So the goals of shareholders and directors may not always align. This conflict is one of the biggest reasons why financial reporting and auditing exist, because shareholders need a way to monitor how well management is running the company. That's why directors are legally required to prepare financial statements. These financial statements allow shareholders to evaluate management's performance. Now let's introduce three very important concepts in auditing and corporate governance. The first one is accountability. Accountability means that the people in the position of power must be answerable for their actions. In simple terms, if someone is managing resource or making important um, decisions, they must be able to explain and justify those decisions. And if they misuse their power, they can be criticized or even punished. Accountability is actually a very key part of a good corporate governance, which is basically about ensuring companies are run properly and ethically. We'll study corporate governance in more detail in another chapter. Now, the next concept is agency. Agency occurs when the party hires another party to perform work on their behalf. So, in a company, shareholders are the principal, directors are the agents. The shareholders appoint directors to run the business on their behalf. But remember the conflict we talked about earlier? Since the agents, directors might not always act in the best interest of the principals, systems like financial reporting and auditing are necessary. This system helped reduce the conflict. Uh, Let me the next yeah so we'll understand stewardship with an example. Imagine you're going on a long vacation abroad and you ask your friend to take care of your house while you're away. Your friend is now responsible for looking after your property. They must make sure nothing is damaged, nothing is misused, and everything is properly maintained. So stewardship simply means the responsibility is taking good care of resources that belong to someone else. Now, about fiduciary, sorry, I cannot pronounce it properly. Fiduciary relationship. Yeah. So, when someone is trusted to manage another person's resources, this creates something called a fiduciary relationship. This relationship is basically a relationship built on trust and good faith. This means that a person managing the resources must act honestly in the best interest of the owner, and in companies, company in companies this exact relationship between the shareholders and directors. Remember something we discussed earlier, the separation of ownership and control? Shareholders own the company but they don't run it. Instead, directors make the business decision and manage the company. Because of this responsibility, uh, directors must act in the interest of shareholders and not in their own personal interest. From an auditing perspective, directors use the stewards of the company. uh, Shareholders are the principals, director acts as agent managing the company. And because directors are running the company on behalf of shareholders, they must be accountable for their actions. This means shareholders have the right to evaluate how well directors are managing the company. And guess what helps shareholders do that? Financial statements and external auditors. Now let's talk about another key concept, stakeholders. Stakeholders are simply people or groups who have an interest in the company and its financial information, and many different stakeholders rely on financial statement to make decisions. For example, first we have shareholders. Shareholders use financial statement to decide whether they should buy more shares, hold their shares, or sell their shares. Because the performance is of the company directly affects the value of the investment. Second, we have employees. Employees might look at financial statement to understand how well the company is performing. For example, if the company is making profits, employees might feel their salary increase should also reflect that success. This might also evaluate whether the company is financially stable enough to provide long-term employment. Third, we have those charged with governance. Um, they are like the people. These are people like board members or audit committees who oversee how management is running the company. They use financial statements to assess whether management is balancing its own rewards like salaries and bonuses with the need of other stakeholders. Another important group is the customers. Customers may look at financial statement to evaluate whether the company is financially strong enough to continue supplying goods or services in the future. In other words, they want to know the company is stable and reliable. Then we have suppliers and lenders. Before giving goods on credit or providing loans, they want to check whether the company is financially stable and capable of repaying its debt. So they rely heavily on financial statement and assess risk. And finally, we have the government. Governments use financial statement to determine whether the company has paid the correct amount of tax and complied with all the rules and regulations. So yeah, so this was it for your first chapter. I hope you found this video useful. One thing, if you found my way of speaking a little fast or some of my pronunciations were unclear, please do let me know in the comment sections. And any doubts or questions you have, you can freely drop them in the comment section and I'll respond to them. And I'll be preparing more such videos, so keep liking my videos and subscribe to my channel for the notifications. And thank you for watching.